I'm Justin Zaks, Vice President of Strategy at Moomoo Technologies. I'd like to welcome you to the fifth webinar of our monthly 7-part series entitled Experience Options Like Never Before. This series will give viewers an exclusive opportunity to learn about a variety of topics related to options from industry experts at the Cboe. I'll also be talking to Cboe experts about their presentation, their professional lives, and their views on various options topics. You, the viewer, will also get a chance near the end of the webinar to ask questions, so make sure to watch the entire show. I wouldn't want you to miss anything. The educational presentation should last about 15 to 20 minutes, followed by questions for a total of about 45 minutes. This webinar is part of a broader collaboration between Moomoo and the Cboe that includes several in-person events and the introduction of index options on the Moomoo platform last November. Today, I would like to welcome Vince Cicco, Director, Retail Derivatives at Cboe. Vince is the bridge between the retail community and the Cboe Exchange and its vast array of options products. The title of his presentation is Beginner's Guide to Zero DTE. Vince will talk to us about what zero DTE options are and some of the reasons you may want to use them. He'll also talk to us about some of the recent changes and growth in the market for these options. Vince will also talk about the difference between cash and physical settlement and some of the common strategies investors use when trading zero DTE options. These slides will be available in the webinar chat, and a replay of this video will be available in-app shortly after this live presentation and on YouTube in a few days. Before we begin, make sure to go to moomoo.com to check out our current sign-up promotions if you're not already a client. If you enjoy this webinar, please check out the live section of the Moomoo app under Discover Moomoo tab to sign up and set a reminder for more of our informative upcoming webinars. Now Vince will start his presentation.
Thanks, Justin. And thank you to everyone who's joined the call, whether Moomoo clients or not. Really thank you for joining. Just a real quick background. I started my career trading options as a market maker. Actually on the American Stock Exchange floor. This is before the New York Stock Exchange acquired it back, just over 15 years ago. I actually traded primarily in single stock names and then, pivoted over to more of a business development role in the industry. In 2010, I joined Cboe in 2015 when the firm I was with, Livewell, got acquired. I've been here ever since, so it's kind of interesting. I started off on the single stock side, and now I'm working at Cboe, where obviously SPX and index options are such a big part of our growth story. So I want to kick things off by just noting tremendous growth we've seen in the options market as a whole over the last few years. Volumes have increased about 3 times in the last 7 years. Up to over 11 billion contracts last year. That's actually that was a record. It's pretty definite. It's pretty certain that we'll make another record this year, particularly with all the activity in the last few days. That definitely has helped push us even higher than we were going into this month. Retail segment does represent a large part of that industry growth, and part of the growth that we've seen is on the zero DTE side. So we're going to cover zero DTE today because it's such a, it's a buzzword in the industry. I think sometimes it gets a bad name, but we're just going to cover at a high level what it means, and we'll take some questions at the end. What is zero DTE? It really, the simplest definition is it's market participants trading options on the day of expiration. So they're really, zero DT is not a new concept. It's something that, options, we don't list, there are no zero DT options that are listed on that day. Typically options are listed weeks or months or even a year in advance or several years in advance. It only becomes zero DTE on expiration day. So eventually every option becomes zero DT at some point, right, on that last day. So it can occur in any symbol, and it does occur in any symbol with listed options, but obviously it's most associated with the liquid index and ETF options that you're probably aware of. That could be SPX, SPY are obviously two of the big ones. We'll cover some other ones as well. So what has changed? I mean, it really is undeniable that zero DT options have exploded in the last few years. So the first start was in 2016, the SPX. If we go back pre-2016, you typically would have Friday, it used to be just a single Friday option a month, right? On the third Friday, essentially. We started listing, SPX started listing Monday and Wednesday in 2016. And then Tuesday, Thursday actually did not get listed until the second quarter of 2022 in SPX. SPY followed suit with Wednesdays and Mondays in 2016 and 18 respectively, and then also later in 2022 added the Tuesday, Thursday. So up until then, there actually weren't options listed every day in SPX or SPY. So a few other symbols have since rounded out the calendar, XSP being one of them. That XSP is our mini SPX contract, which I'm sure you've heard about. You may have heard about. We added those in fourth quarter 22. The Russell 2000, the Tuesday Thursdays got added earlier this year, and then IWM and QQQ also now offer expirations every day of the week. So getting to to sort of the growth story. So zero DTE volume has grown 60% annually from 2016 to 2023, on pace to hit another record this year. Non-zero DTE and SPX has grown at 7% annually. So, it's the entire curve. We're seeing, in all expirations, we're seeing more volume. Obviously, the increase has been more dramatic on the 0-day side, but there has been healthy growth across the entire option chain. 45% of total SPX volume in 2023 was 0DT. We typically see between 45 and 50%. And that's pretty consistent. It's not, we don't see these big variations from month to month. An interesting stat is now 20% of the total listed options volume in 2023 was 0 days to expiration. And that's that stands out because only that small handful of symbols list options every day of the week. And most underlyings, and there's thousands of optionable underlyings, most underlyings still only have that Friday expiration. But even so, 20% of total listed options volume was 0DT last year. So why are 0DT strategies popular? So, I think this is one that, there's sometimes some misconceptions out there. But first, they really do give you a way to tactically trade. So let's say you're a retail investor, most retail investors, their positions are just going to be net long. Most investors, period. Generally, there's a long bias to the positions. Let's say you're nervous about an economic number or some things that are going on in the macro, but you don't want to sell out your positions. So one potential use of 0DTE is to tactically hedge that position off, right? So if your position in the market is generally bullish, you can buy a 1 day or short duration, doesn't necessarily have to be 1 day, but since we're talking about 0DTE, you could buy a short-term put to kind of protect yourself for that amount of time till expiration, right? So, and that would help you in not necessarily needing to sell out positions. It's just basically a hedge against your long book. And second, particularly in the large ETFs and indices, which is the vast majority of where 0DT is trading, near-term options tend to be highly liquid, very tight bid-ask spreads. We'll often see, you'll see 100,000 contracts trade on a single strike in a given day. That's the majority of underlyings, their entire options volume doesn't typically equate to 100,000 contracts in a day. So we may see as much in single strike or in a handful of strikes that other other underlyings might see in their entire option chain. And then third, premiums. It follows on to some of the other points we've made. The premiums are generally lower. Well, they are lower given the smaller time to expiration, right? So now that's not to say there aren't risks. Obviously, options are leverage instruments, and that leverage only goes up as time to expiration goes down, right? So a contract that expires today, there's a considerable amount of leverage. So Greeks are amplified. There's obviously less time to adjust when you're trading 0DTE options. Some other risks, and we'll talk about this on a handful of slides coming up here. Some other risks that are native to ETF and single stock options are the physical settlement, and we'll cover why that's a nuance that you should consider. Also, contra exercise risks after the market close, and those again are mitigated by cash settled index option contracts. So to give an example, and just we're going to cover some of the differences between index and ETF options. So cash and physical settlement. So when you think about this actually shows how much the market had moved for some time. I took this snap in January. Both XSP and SPY, let's say they close at 476.68. I'm using this for example purposes. XSP and SPY. So XSP, I had mentioned, is 1/10 the size of SPX. So notionally, it's almost the exact same size. It's basically SPY. It's typically off by $1 or so. There's some nuance to the contracts, but generally they're pretty much perfectly correlated. So XSP and SPY, let's just say for argument purposes, they close at the exact same level on January 12th. In the case of an index option, which is XSP, customer being long a 475 call, and if you look at the example, customers long the 475 call, so the position expires in the money at 476.68. In the case of an index option, that settles to cash. It's one contract times $1.68 times that 100 multiplier, which you're probably familiar with. That's $168 cash credit to the account, and there's no residual position past that. When you look at the ETF options example, and SPY is just one example, you could think of any single stock or ETF that has physical settlement. If you're long that 475 call and the position expires in the money, again at 476.68, the customer will exercise their long call option. That's provided they didn't sell out of it earlier, but if they decide they want to hold to expiration and exercise the long call option, they have to pay $475 for each of 100 shares. So that's a $47,000 cash outlay and a residual position, right? So you're long that 100 share position until, maybe you want to be long that position. But if you don't, you hold that position and have that potential market gap risk, which can occur. So that's one of the major distinctions between between index and ETF and single stock options, is that the index options settle to cash and the close is the close, right? And then ETF, obviously, you have to exercise into an underlying position. So those are really two of the major ones. Those are sort of the major. I think probably the biggest distinction when we think from a 0DTE perspective. So common 0-day strategies, they vary by product. SPX volumes, historically, we've seen, and this predates 0DTE, typically SPX, we see more complex trades. So what a complex trade is, if you think of a vertical spread, or a bull call spread or a bear put spread, those are complex trades. When we say single leg, it's just buying a call outright or buying a put outright. So index and particularly SPX volumes are nearly split evenly between single leg and complex. So that leads to some conclusions we'll get to later, where the market maker positioning is fairly balanced given these large volumes that we're seeing in 0DTE and SPX. The market maker positioning is pretty remarkably balanced because of that two-sided trading. SPY 0DT volumes tend to be more outright single leg. We certainly see spreads trade there and complex trades as well. But, just generalizing SPX, the percentage of spreads that you'll see is higher than you'll see in SPY. And here's some estimates from 2023. I've not updated this for 2024 yet, but generally speaking, you see all these complex trades from put spreads, call spreads, condors, which are, an iron condor is basically the combination of a short put spread and a short call spread. And then other, that's encompassing multi-leg strategies as well. So basically in 2023, it was, 57 to 43 about in favor of complex. That might have come down a little tick, but, generally speaking, you could say at a high level, it's, relatively even split between complex and single leg. Looking at the SPY and a lot of single stocks that, when they do trade on the day of expiration, more outright calls and puts. So taking a step further, some of these examples I had mentioned, the iron condor, some of the things that we'll see, most of you I'm sure are familiar with an outright single leg purchase, and that's just, you buy something at 50 cents, and if you buy a call, you're obviously looking for the stock to go up, and buying a put, you're looking for the stock to go down. And when you take a look at spreads, that's a combination strategy where a common thing that we see are credit spreads where somebody is selling the spread. So when you talk about selling a call spread, an example would be you sell a call short at, you sell the 500 call. Let's say we're using XSP or SPY, and then you buy the 510 call. So you're taking in a credit because you're selling the call that's closer to the at the money, or close, with the more value. The trade becomes profitable, and we're using SPX in the example here actually. So let's say 5,025 call spread. The trade would become profitable if SPX moves down or stays the same, or moves below the price of the short strike. We do have some slides here. You can kind of review the payoff diagrams. The maximum loss in these call spreads or put spreads is the width of the strikes that you sell minus the premium that you collect. So let's say you sell for a $5 call spread and you sell it for $2, your maximum loss is at $5 minus $2, so $3 times the multiplier, which would be $100, right? So, so 3 times 100 is 300 in that example. Iron condor is, I mentioned it before, it's just a short call spread and a short put spread together. So, you obviously, obviously the stock can go against you either way, but you're collecting on both the call and the put spread, right? So, and again, max loss is the width minus the credit received, right? So, and again, you'll be able to take a look at the slides later on. So one thing, in this one, it probably goes a little bit past beginner level, but I think it's instructive to kind of put, a couple of the, there's some narratives out there that, positions are highly concentrated. But we actually have an example from last December 28th or December 20th, where the market fell 1.5%, with an intraday move of, slightly over that at 1.7% following lower rate cut expectations. So we had a massive, SPX traded 4.2 million contracts that day, which is still, I believe, probably a top 10 day ever. It's top 10 to 20 day ever. At that time, it was sixth highest ever. 1.9 million of those were the 0DTE contracts. But the largest imbalance, even with that enormous amount of contracts trading, the total imbalance was only 17,000 puts. And the largest imbalance was on one line where customers were net short 10,000 of those puts. So the reason for that is because of the two-sided trading that we mentioned before. There's a lot of spreads going on. Not everybody is trading the same complex trades. You also have people trading outright, right? So a lot of these strategies tend to, to counteract against one another. And what, the end result is the market makers aren't necessarily accumulating as enormous of positions as you would think, just based on the total volumes that you see traded. Really, only a fraction of that typically is shown in their net positioning intraday, just because of that two-sided nature where it's trading back and forth. So just wanted to add these real quickly. Cboe index options available through Moomoo with less than one expiration per week. I'm sorry, with greater than one. I got my signs wrong. With greater than one expiration per week. So these are contracts you can take a look at. As obviously, SPX is the one that is most known as far as the index options goes. XSP, another great product. It's 1/10 the size of SPX, so the notional is a little more manageable. It's a smaller size contract. And then the RUT, which we added the expirations, the every day of the week expirations earlier this year. Have some content here on benefits of index options, which we covered on a previous webinar. So with that, we have some resources here. I guess we can point those out later. But just do realize there's a lot of literature, both on, you could get it through your broker, through Moomoo. And we also have some on the Cboe website to help dispel some of the myths, but also just kind of explain what's going on. Honestly, talk about potential risk and definitely. And we have a great thing for a market intelligence, from our chief market strategist Mandy Zhu, which I think is a good download for you guys as well. So with that, I'll take it open to take some questions, Justin.
Thanks a lot, Vince, for that really informative presentation. I just want to remind everyone, there is a link to the slides in the chat in case you weren't able to follow them exactly, and they'll be available. And Vince mentioned some of these other episodes we've done before. So there's been 4 previous episodes, and you can find them on YouTube. You can also find them in the Moomoo app. And you can please follow the Cboe account in the Moomoo app, in the Moomoo community. And I just want to talk a little bit about this general webinar, and it's called, Beginner's Guide to 0DTE. And that can mean different things for different people. Some people are going to be coming to this with knowledge about options that is pretty extensive, but they really don't know about 0DTE and 0 days to expiration. Other people may be coming to options, say, I don't really know that much about options generally. And so I want to back up a little bit, Vince, and let's address that cohort first. And let's talk a little bit about people that maybe are just starting out, and just a few questions for you. What is an option? What is a call? And what is a put?
Yeah, so I think it does help to think of them separately, the calls and the puts. But an option contract, generally, it's a financial instrument where the buyer has the right, but not the obligation to buy or sell an underlying asset. So, it sounds like I'm speaking out of both sides of my mouth, but that's because, we just defined options generally. But if you just think of a call option gives the buyer the right to buy the underlying asset at a specific strike price, right? So taking that as an example, let's say a stock is trading $48. If you buy the January 50 call that call buyer has the right to buy that underlying asset. So XXX, let's say, at $50. So obviously, if the stock does not go over $50, they're not going to want to exercise that option. So that's where the point I made earlier that it's a right but not an obligation. That's where that comes into play, right? So you could just, if you buy a call, the most you can lose is what you paid for that call. You're not forced to exercise later on. A put is sort of the flip of a call. It gives you the right to sell an underlying asset at a specified price. So a lot of times it'll be used to protect a long stock position or something like that.
I think that's a really great explanation for all the people that are kind of just starting out. And then I just want to remind everyone that's watching, please continue to put those questions. We've had a lot of great questions so far. We're going to get to some of the questions from the audience. I won't be able to cover them all, but keep those questions coming in. And for this one, I do have a question that is from the audience. And you mentioned this in your presentation, but I want to go over it again. And it's really the difference between a zero DTE. And again, when we're talking about zero DTE, that just stands, it's an acronym, 0 days to expiration, and any other option. And the user question I got was, are QQQ and SPY zero DTE? And I think people get a little bit confused about that part. And maybe you can help us just go over this again one more time for everyone.
Yeah. So I guess to be clear, any option at some point in its life cycle becomes zero DTE. Zero DTE is just options trading on the day of expiration, right? Where I think there may be some confusion is people thinking that these are products that are listed on that day for trading that day. That's not the case. It's just basically where it is in the life cycle. But to the question, SPY and QQQ, I believe you mentioned, they, I think what you're really getting at is, do they have expirations every day? And yes, they do. So there are certain, if you're talking about a single stock, most of that, all of them do not have expirations every single day of the week. The ones that do are some of the indexes we mentioned, SPY, QQQ, IWM. They do offer expirations every single day of the week, right? So I hope that answers the question. But yeah, to be clear, like at some point in an options life cycle, it will become a zero DTE option, because there's basically any trading on that day of expiration is considered zero DTE. It's just that there's that small symbol list where there are expirations every single day. So I hope that answers the question well, Justin.
Yeah, that's really great. I mean, I always like to think about it. It's like, you think what the date is today, and if the option expires today, then that's zero DTE. And it sometimes gets a little bit confusing, because some people think of zero as nothing, right? And so there is time, it's just less than one. And that's the important part to kind of understand. And everything that's tomorrow or a week or a month from now, that's not zero DTE. But again, we don't want to confuse this with, the actual, contracts, which, shift from being a non-zero DTE to a zero DTE option. And so a product is different from an option. It's really about the timing. And it's really, when I think about it, is the date today, does it expire today? That's zero DTE. And that's the options we're talking about. And I want to talk a little bit about more about the popularity. Do you have any additional thoughts on why people love to trade zero DTE, or what some people do, obviously, or there's an increased volume? Any thoughts around that?
Yeah, I mean, I think, they're generally, and I don't want to speak in too much in generalities here, right? But that there tend to be in the most liquid symbols, right? So I mean, these aren't listed in options with really wide markets, right? These are listed only in the most active index and ETF symbols. So they tend to be highly liquid. They obviously have a lot of sensitivity to price, so they can move around, right? And that's, there's risk and reward that comes with that, obviously. So I think obviously, part of it is just the fact that they're very liquid. you can really tactically trade. And I had mentioned that on a previous slide that, it just gives you, instead of, when we were talking about, wanting to put on a hedge earlier on, like you might only care to hedge for a small period of time, right? Maybe you're just worried about an economic number, and that they just give you the option to do that pretty nimbly. And then third, they're typically lower price because they have a smaller time to expiration. Now, obviously, the trade-off for having a lower price is there's less time for the stock or the index to move, or the ETF to move in your direction. But those are three of the primary reasons for popularity. I imagine there's others, but those are three off the top of my head.
No, that's a really great explanation. I'm sure a lot of people are wanting, to understand the popularity around it and see if it's for them or not. And a lot of beginners, when they're doing zero DTE options, and honestly, a lot of other non-zero DTE options, they're trading outright calls and puts. And for people to understand that means that they're naked selling or they're naked buying just one options contract, either a call or put. Can you address the risk around this? And are there other types of strategies zero DTE traders should consider?
Yeah, I mean, I think when you start talking about outright calls and puts, any zero DTE option, there's the options in general are leveraged. So zero DTE options are, there's even more leverage, right? So what happens is the decay, if you own an option and it doesn't go in your direction, so let's say you own that call example, the example where you own a call, if the stock doesn't move up fairly quickly for you, I mean, you only have a maximum of 6.5 hours. If you trade at the beginning of the day to the end, there's it's going to, if the stock doesn't move in your direction, it's going to decay to zero, right? So that's a risk in trading, obviously, any option contract really on the last day. And so that becomes more outsized as expiration goes down, like the decay gets faster. But choice of the strategy, it's really ultimately defined by your risk tolerance. Like people that do premium selling strategies, they're looking, it's just a different payoff profile, right? They may be looking to capture, typically option, again, general rule, but not something that always is always in place, is typically, implied volatility trades at a slight premium to realized volatility. So in other words, what people price the options at is a little higher than the underlying actually moves. And if you look at that over time, that has held up fairly consistently over the years. So, the people that are doing credit spreads or credit strategies are typically trying to capture that difference. Obviously, you open yourself up to, stock can go through you, right? So through your short option, and you can obviously lose to that side of the trade as well, right? So it's just, again, it's a matter of risk tolerance. And when you start talking vertical spreads, also there's a lot of variables that you could choose a different width of your spread. You can sell closer to the money or further out from the money. So I would say, none of these strategies are without risk. It's just what type of risk do you want to take on, and what type of reward are you looking for?
Yeah, and in that, I just want to go over it again. We had another question from someone who's just starting out here, and they just want to, a better clarification on what a spread is. So just so everyone understands that.
Yeah, so a spread involves two or more legs to the trade. So stepping back to the single leg, so not a spread. So a single leg is you're just buying a call or buying a put, right? So that's just like an outright single leg. A spread, like a call spread, might be you sell the 50 call and you buy the 55 call. And what that does is that, if you were just selling a 50 call, then you have uncapped risk to the upside. If you do a spread, you you collect less, if you're selling a spread, but you're also stopping yourself out if the stock goes well through the level that you sold, right? So basically, if you sell a 50-55 call spread for $3, the most you could lose is $2. Times a multiplier. Now, if you take a look at just selling a call outright, and maybe you sell a call outright for $3, and it's difficult for retail to just sell naked calls or naked puts. But if you sell naked call or put, and you don't have a spread against it, obviously your risk to the to the upside in the case of a call is not stopped out by the fact that because you don't have a long call to offset it, right? So that's really the difference. Is a spread is typically lowering the cost of your trade, but limiting the amount of risk that you're taking, limiting the amount of max risk.
Yeah, I think that's a real important concept to understand, that when you're doing a spread, the amount of money you can make and the amount of money you can lose there's always a finite limit on that, depending on what strikes you choose. And another thing I'm getting a lot of questions about is that they want to know about when a retail trader makes a trade, who's taking that other side of it. And they want to know about something called delta hedging. And so can you explain a little bit about who's taking the other sides and how professionals are also involved in this market?
So, it's important, I guess, to distinguish between what you might be accustomed to on the equity market versus an options market, right? Like, so an equity market is more order driven, because there's only one underlying. If you're trading Meta, there's one, so you could either buy it or sell it, right? With options, there are often thousands and thousands of strikes or series in a particular symbol, right? So what that means is there's less of a there's I forget the number, but it's well over 1.5 million series in the market right now, right? So the market maker has to be willing to either buy or sell on a lot of different series. So in the case of options, you're typically trading against a market maker. So, if you buy an option, a market maker is probably selling it to you in the majority of cases, right? So they have strong obligations to make those two-sided markets. But, in a perfect world for a market maker, there's an even split between buyers and sellers, because they're not looking to accumulate a ton of risk and exposure. So what'll happen is if people are doing nothing but buying a certain strike, the market maker, will have to sell it to them, right? But they will raise their price and raise their price and raise their price until they start to see sellers come in, and until you start to get a two-sided trading, right? So obviously, if customers are doing nothing but buying options, that's going to raise the price of the option in, either in real terms or implied volatility terms. Like the market maker has to react by trying to get the other side to come into the market so they could get two-sided trading.
And so the market makers are often hedging their exposure to these options with the underlying security. In this case, it would be a stock, right? Can you talk a little bit about the delta part of it, and what a lot of people have heard of the Greeks. So maybe we just step back and say, what are the Greeks, and then what is delta, and how does that work with a hedge?
So yeah, and this doesn't necessarily clearly it doesn't necessarily limit itself to 0 DTE, right? So if you're just talking about delta hedging, again, to put on, think of the market makers, the market makers' role in the market, right? What they're looking to do is maintain as little, they're trying to maintain as little risk as possible and get that two-sided trading, right? So if somebody is, I think you mentioned, what are some of the Greeks? So one of the common Greeks is delta. so delta is just basically the amount an options price is expected to move for every dollar move in the underlying. So if the stock is, and we keep going back to that $50 example, let's say that the delta would be 50-ish, right? So, so basically if the market maker is selling selling a call option, they're going short deltas, and because they don't want to accumulate large delta positions or Greek positions, they will hedge that off some way. So there's different ways to hedge. You could hedge with other options. But if we're just talking about hedging with stock, if somebody, if a market maker wants to perfectly hedge, right, and they sell, one options contract with 50 deltas, they're looking to buy 50 deltas of the stock, right? So 50 shares of stock. So basically, I mean, that's it. It's just basically, if you're buying a call, that means the market maker is selling the call. So from the market maker's position, if they're selling the call, their way to hedge is to buy stock. So conversely, if they're selling a put, their hedge is to sell stock. Again, that's simplifying, some of the different hedges they might put on. But if we're talking about it in stock terms, if you're selling a call as a market maker, you're going to have to buy stock to hedge against that. If you're buying a put, you're going to buy stock to hedge against that. So it's really just trying to stay as neutral as they can from an exposure standpoint.
That's a great explanation, and I think I want to touch on two other Greeks that are pretty sensitive to zero in terms of zero DTE. And the first one is gamma. And can you explain what gamma is and why gamma is so much bigger for zero DTE options than it is for some other options?
Yeah, that's certainly, gamma is a tougher one to explain in a 101 level class, right? Yeah. So, we mentioned the delta. What delta is, gamma is the rate of change of delta, right? So, I mean, it's not an easy thing to comprehend necessarily, but if you think about gamma, again, it's the rate of change of that options delta that we just covered. So thinking of an example, as you're nearing expiration, you think about it, again, we keep going back to that $50 example. If the stock moves to $52, and you're long a call, there's a very good chance that's going to be in the money. So, that delta flipped from 50 to nearly 100 very quickly. So, again, the delta is essentially, delta is almost like the probability, if you think of, the probability that's going to finish in the money.
So something like if the option's a year out, you're not going to see that flip that quickly, right?
Right. That's the example, right? Is if you're buying a 50 call and the stock goes to $52 and there's an hour left to expiration, it's a very strong likelihood that that's going to finish in the money, and that's very close to 100 delta. If you go a year out, if your options expiration is a year out, and it's, again, you have the 50 call and the stock is trading $52, there's a good chance that it's going to be below $50 before expiration, right? So yeah, gamma gets dramatically higher as time to expiration goes down. And again, I apologize, there's not a really simple explanation for it.
Yeah, and we try on this, and we're going to get into that on another webinar a little bit more about these Greeks. And I just want to touch base on it quickly because it does affect zero DTE. But kind of moving on, I think a lot of people are just interested in what's going on in markets this week and on Monday. And it looks like the volatility has increased kind of across the board. Implied volatilities have increased, realized volatilities have increased. Just kind of want to get your idea on why this is happening, what you see behind there, and also what should traders be aware of in this type of scenario versus what we saw in the first half of the year? Should you be more careful, or where do they have what do they have to think about when volatility is a lot higher than it was a month or 2 or 3 months ago?
Yeah, I mean, I think it's natural, when the markets, when the Nikkei cratered, earlier this week, it's natural there's more fear in the market, right? And or people are pricing, fear. I don't necessarily love the word fear, but they're pricing in more risk, right? So they will raise the price of that option. The market's going to adjust the price of that option higher because naturally there's a bigger chance of a big move to follow, right? So we actually had our data guru pull some numbers, and he sent out a note the other day. It was something like the 1 day SPX at the money straddle this year has typically been in the like $12 to $25 range. The other day it was that 1 day straddle just after 9:30 was over $100. So people are just pricing in more of a move just based on, I mean, it's natural. I mean, if you see overseas down 12%, you're not, definitely something has changed macroeconomically, and those, you're going to typically adjust prices upward, right? So, so, it's, it really, it's driven by those large moves. Yeah, I'm not sure if, obviously they came in quite a bit after, the market didn't quite follow, the damage on Monday was more close to open than it was after the open, right? So eventually the volatility settled in a little bit. I think it was, we have a measure called the VIX, which is the volatility index, and that was I think trading near 60 or over 60 pre-open, or the level was over 60 pre-open, and then it ended up settling in considerably from there. I mean, I think it's just very natural that you see these big moves overseas, and clearly you're going to price risk differently after a massive overnight move than you would price it having not seen that.
Yeah, and I think you brought up a lot of good points, and I had this other question from one of the viewers, and he's asking how options are priced, and you got a little bit into that, and then for options buyers, are there any tools that you can look at? And certainly Moomoo has a great tool with an options calculator, and you can see how these options prices change with changes in volatility, and going back to some of these numbers Vince talked about, I want to make sure viewers really understand how much this is going to cost you, and how different it was. So if you were buying an option at 12 when the straddle was 12, or based on a volatility that was where straddle's 12 or 25 and now it's 100, you're paying anywhere from 4 to 8 times more for an option. So you're going to have to see some really significant movement even just to break even. And so that's an important part. So if you were going in there and trading 0DTE every day, now you're paying 4 to 8 times as much. So you really have to think about that if you're going to do these, these long only naked options that are not spreads and things like that. So your costs are going to go up significantly, and this should factor into the strategies that you're using. And one of the other topics I wanted to get into was this, you talked about the cash versus physical settlement, index versus ETFs. And I think this is an important, the differences here are really important when it comes to 0DTE, because particularly in that last hour, the prices may vary a lot from what they would be, a week, out or something like that. Can you talk about the expiration times and what this might mean when we have earnings after hours or some other types of events?
Yeah, and one we didn't cover in too much detail, but I think I briefly alluded to it on an earlier slide. Really, when you think about the cash and physical settlement, like the big difference, the there are no contra exercises of index options, right? So it's basically the close is the close. So, that's different than an ETF or single stock option, right? So a long option holder in ETFs or single stock, they can decide not to exercise their in the money position if the market goes against them after the close. They have like an hour window issue or so, right? Or flip side, maybe their position wasn't in the money, but there's a big move after the close up, and then their position becomes in the money, and then that long holder is going to exercise their position, right? So there's there's an added degree, I guess, of optionality there where as a long option holder, you have the ability to do a do not exercise or a contra do exercise after the close. Now, that's all well and good on the long side, but if you think about being on the other side on a short position, that means that you don't necessarily know what your position will be if you will get assigned, right? Because you're not in control when you're short that option, right? So if you're short that option and the long option holder decides they want to exercise, that means that you're going to have to deliver shares, right? So that's the big difference between index and index and ETFs and single stocks. Is the index, there is no, the index, the underlying is the value, and that's why it settles to cash. And then you would not be, obviously not have to provide that delivery like you do on the single stock or ETF side. I do think, this can get pretty complicated. So I know there's a future webinar where we'll cover that in more detail. And again, we have some good resources on the website to describe it in more detail.
Yeah, and I just want to reiterate, this is, options are not easy for everyone and not easy for most people. And so it takes a while. So when you're just starting out, and hopefully we're able to address some of the beginner questions, and we got to some of the more intermediate questions here as well. And we're going to have more webinars. There's lots of great educational materials, both with Cboe and Moomoo. So please make sure to check those out. I really want to thank Vince for being our guest today. And I want to thank you for all your questions. Unfortunately, we're not able to get we could probably go on for hours if we had time. And been really great. Any last thoughts about 0DTE options for our audience?
No, I mean, I think we covered it pretty well. I would just say, like any other trading, definitely understand your risks before getting in. I would say, once you kind of do your research, you start small, and definitely, kind of step into it like you would, any other investment. You definitely want to make sure you're cognizant of all the potential risks and rewards, and and there's, like Justin said, there's great literature both on the Cboe website and on Moomoo, to where you could help kind of bring up your level before getting involved.
All right. That's great. And I want to thank all the viewers for tuning in. We're going to be back with another great Cboe webinar on the 30th of September. Keep an eye out for the preview on that. And also, please make sure to download the Moomoo app and keep you abreast of our upcoming educational webinars and other ones. Moomoo does some of their own, including we'll have one around Jackson Hole in the meeting of the central bankers later this month. And again, we have those slides that are in the webinars, and you can check that out online. Thank you very much, everyone. Have a great trading day.